Hey, everybody, we are going to talk about Prologis, one of my favorite real estate companies to talk about. It's an amazing business, and it's one that I have added shares to my portfolio in the past couple months. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now for free from the Motley Fool. It is the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So, Prologis, they always have to be first when it comes to real estate companies reporting their earnings. That was, no exception right here. So we've already seen their fourth quarter and year end results, and on the surface it looks really impressive. Core FFO, funds from operations, which is like earnings for real estate, was up a little over 10% if you exclude one-time items. Um, Customer retention is actually trending in the right direction after a few quarters of not doing so. Um, and shares are down by about 20% from the 52-week high, mainly because of interest rate headwinds, not because any big surprises in the earnings themselves. So leasing activity has been strong. Prologis has a lot to like. There's a lot of rent growth embedded in the portfolio. We've talked about this in videos before. In the fourth quarter, Prologis reported a cash rent change of 40%. That means if your lease expired on your apartment and you started paying an extra 40% the next month, that's essentially what's happening here. A lot of their leases that are expiring now were originated in the pre-pandemic era. And then what happened was you saw a surge of demand for industrial properties. Rent went through the roof. And now we're starting to see these leases reset to the market rates. It's creating a lot of and when I said core FFO was up by 10%, that's a lot of what's driving it, if I'm being totally honest. But the company is still developing properties from the ground up. They have a great track record of creating value from developing properties. Just to kind of, in simple terms, if you could build a property for $5 million and sell it for $6 million, you've created $1 million. And that's essentially what they're doing. They actually sold one of their new data center properties before it was finished because there's so much demand for them right now. And they created a lot of shareholder value in that way. And last thing I want to say before I turn it over to Tyler, Prologis ticker symbol's PLD, by the way, so don't leave me any comments. I didn't put the ticker symbol. I know we're pretty bad about that. Whenever I'm on with Tyler, we're terrible about that. But they're not only the largest real estate company in the market, but they have in my opinion, the best financial flexibility of any real estate company. Um, they're one of a handful of real estate investment trusts that have A-rated credit, over $7 billion in liquidity, and this stat just kind of blows my mind. In their most recent quarter, Prologis issued a total of $1.5 billion in debt at an average interest rate of 3.5%. The U.S. government can't borrow money at 3.5% right now. I know Tyler and I have talked about some of the smaller industrial REITs on this channel. Which one's Tyler's favorite? Is it Rexford?
Rexford.
Yeah. They can't borrow money at 3.5%. I think we can both agree on that. So it's somewhat of a competitive advantage when it comes to growth. But on the other hand, is Prologis too big? Can they really take advantage of growth in the way that their smaller counterparts can? So, Tyler, what are your thoughts on this quarter and just where Prologis stands as a whole?
Well, I mean, I think you stole my talking point about the interest rates,
Sorry.
but it's fine. I mean, it's part of Prologis's like global footprint, because if you look at when they issue those sort of bonds that are like, oh my goodness, how did they get such low interest rates? It tends to be European debt. For a lot of its European assets, because you can get much cheaper debt in Europe today relative to what you can get in the United States. So it's not like, it's US denominated or dollar denominated debt for US properties is less than treasuries. It's just a product of it being a global business. But that's good, right? Like they know how to, take out debt where it should to leverage the business. A couple of things kind of stood out. I mean, everything that you said is good. I think overall the quarter was good. One thing that did stand out to me was on the full year, and perhaps this is why reaction to the results was tepid, was that its core FFO per share for the all of 2024 was actually down 0.9%. Now, they made the adjustment. It says if you exclude net promote income, which is kind of like this, it's like a management sort of aspect of the business. It would say it increased 8.4%. So there was like this, the bread and butter part of its business of owning properties and leasing them had an 8.4% increase on an FFO basis. But like, you own the whole business, right? You have to take the net promote income or expense, if you will, into account here. And so we did see a little bit of a decline, which is, obviously not great. It's the net promote income is like a newer aspect of the business. It's only a couple of years old. So it's one of those things where it's like, maybe this will be good, maybe it won't. It's hard to really like suss out precisely how this is going to be like a long-term gain for the company. In theory, it sounds like it would work, but you could poke holes into it relatively quickly. The other thing that kind of stood out to me was that guidance for the 2025 was a little tepid, I guess, if you will. Despite the talks of net lease spreads, cash on cash increases for leases still being very high. They were only projecting $5.70 to $5.80 in FFO per share, compared to $5.53 for the full fiscal year 2024. So it's pretty slow, but I think when you get to the size that you are at Prologis, that's kind of the nature of the beast, right? Like you get so large as a real estate company, you can't grow at double digits. You can't grow at these startup really move the needle sort of businesses. You would have to, build a real estate portfolio equivalent to like, the entire footprint of France's industrial real estate to really move the needle for this business. And that's, actually pulling that off is quite challenging.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investments. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.